All right. Welcome, welcome. I just want to make sure that the audio is correct. That you guys can hear me perfectly fine. Nothing's wrong. Audio is correct. Awesome, perfect. Yeah, I'm just going to make sure that the visuals are also okay. There's a bit of an echo. Yeah, there's going to be a little bit of an echo because I'm in my office. That's why the echo is normal. Okay, so let's take a look here. Okay, it's not bad. Not bad. The video is actually not bad at all. How long are you planning on making this? It's probably gonna go for another hour or something like that. Let's take a look here. All right, welcome everyone. I guess we're gonna start here soon. Just give me a moment here. All right, beautiful. So I'm just gonna wait. We're gonna wait about 5 minutes for some people to show up, and then we're gonna continue on. So basically, what we're gonna do today is we're gonna go over a few topics, right? The first topic is gonna be market sessions. It's going to be the first topic, market sessions. Oh, obviously, this webinar is brought to you by, I'm going to place it right here, Dominion Markets. Let's place it right over there. Something new we're starting now. Markets. Perfect. These are the sponsors here for today. So we're going to go over market sessions. Then we're going to go over candles. Then we're going to go over reading, REA, reading trend. Then we're going to go over reading, trending candles. Reading, trending candles. After that, we're going to look at ranges. And then we're going to go into your take profits and stop losses and all that fun stuff. So, okay, it's pretty good. Awesome. Of course, we have guys here giving their opinions. That's fine. Okay, so we're going to wait about 5 minutes, and then we're going to continue on with this webinar and see how far we go. Well, most of the webinar is a virtual class. Someone is saying, get a bigger board. How about you send me one? Awesome. So yeah, it's about 8:04 right now. At 8:10, we're gonna continue on. I think these are the basic topics that people don't realize. I think the number one important thing that people don't realize is market sessions. Because if you don't know which session you're trading or which session to look at, you're never going to find enough volume to place trades, right? It's going to get very, very difficult. At the same time, people don't know how to read candles, reading trends. I mean, identifying when there's going to be a trending market or when there's going to be a ranging market. I think that's also very, very important. So, okay. Awesome. We got around 900 people in here. Let's wait about 4 more minutes, and then I'm going to be back here. So we're going to wait 4 minutes. All right, wonderful. Let's do this here. So what I'm gonna do is I'm gonna put my phone on silent. I'm gonna put my phone on silent over here. Hopefully I don't break anything. Okay, there we go. Phone is turned to silent. Awesome. Much clearer over here. And maybe move this laptop down over here. Awesome. Perfect. Things are much better now. Is this a Christmas gift that you're talking about in your regular trading session? Yeah, probably. Yeah. Let's talk about this Christmas gift here. Okay. Let me just get my coffee here. First thing in the morning, 8 a.m. Okay, awesome, perfect. So what we talked about before, we're just gonna remove that, later on. But awesome. Welcome everyone. Welcome to the first session of your virtual class over here. I know 2021 is gonna start soon, and before 2021 starts, I think it's really important that we kind of brush up on some topics here. So the first thing that we're going to talk about today is going to be market sessions, which sessions to basically look at where there's going to be a lot of volume, right? And then slowly we're going to move into candles and reading candles and trending and candles with no wicks and all that fun stuff. So let's start here. Market sessions. So we all know there are 3 market sessions. Number 1, we have your Asian session, right? Number 2, you have your London session. Number 3, we have everyone's favorite New York session, right? So I think the number 1 thing we need to understand is that, okay, if we have the Asian session, when is this going to be volume in the Asian session, right? What time there's going to be volume? Because whenever there's going to be volume in the Asian session, that's the time when you should be trading. So if you look at the Asian session, what I've seen personally is that there's going to be some sort of volume from, let's say, 6 p.m. Eastern all the way to 9 p.m. Eastern, right? These are Eastern Standard Time, so you can basically go to Google and try to convert this time to your local time and whatever that time is, right? So this is the time when there's going to be volume in the Asian session. And if you trade the Asian session, you might notice that after 9 p.m. or after 9:30 p.m., price mainly starts to range. The volume starts to die down. They're not bigger moves at all. Same thing when we look at the London session, we have to understand that in London session, we have 2 parts, right? The first part, you have volume around 1 a.m. Eastern. Sorry about my handwriting here. And it goes all the way towards around 2:30 a.m., right? 2:30 a.m. So this is pre-London. From 1 a.m. Eastern to 2:30 a.m. Eastern, this is pre-London. Pre-London is when when the orders start to come in, when the market's about to open, so there's some sort of volume in the session to see, okay, what orders came in before that. After that, you have your actual London open, which is at 3 a.m. and it goes all the way towards 4:30 a.m. Eastern, right? Next, we have the New York session. New York session is a very high volume session, right? It's really volatile. And the way we're going to look at it is there's going to be pre-New York, which is my favorite, obviously. It starts at 6 a.m. Eastern. This goes all the way to, I would say, New York open. So I'm going to say it around 7:30 a.m. Eastern, right? So all times are basically in Eastern Standard Time, right? So this is pre-New York. Pre-New York, after pre-New York, you have New York Open, which is 8 a.m. Eastern. And after New York Open, you have the NYSE Open, right? Most people confuse NYSE with NYC. NYC is New York City, right? NYSE is New York Stock Exchange. So these are 2 big differences, right? So then you have 9:30 a.m. Eastern. This is the NYSE Open, New York Stock Exchange. This is when there's volume in the market. And we're going to talk about volume here in a little bit. After this, you have London close. London close volume usually starts from 8 a.m., 10 a.m., sorry, and it goes to I would say 11 a.m. Eastern, right? So over here, what we have is we have 1, 2, 3, 4, 5, 6, 7. We have 7 volume times, right? What this means is that these are the times when there's a lot of volume in the market, right? So now what you have to identify is you have to identify that, okay, which time will suit you best in your life, right? Let's say you have somebody who works in the morning time. So for someone who works in the morning, maybe this time will suit them best in the evening time. If someone works in the evening time, maybe the morning time suits them best. So that's something you have to like identify that, okay, what times are you going to be able to look at the charts? Because here's the thing, right? We have guys looking at charts at the Asian session. There's some volume at that time, and what's going to happen is that they won't stop at 9 p.m. They'll continue to look at the Asian session at 10 p.m. and 11 p.m. when the volume is dying. It makes no sense. It makes no sense to look at the market when there's no volume in the market, right? Same thing goes towards your London session. For London, you have pre-London from 1 a.m. to 2:30 a.m. There's a lot of volume at that time. Right after that, you have London Open from 3 a.m. to 4:30 a.m. There's also a lot of volume at that time. And the best way to measure volume is if you look back to your charts, what you're going to see is you will see big candles, right? So when you see big candles at those times, that means there's a lot of volume at that time, right? At the same time, when we look at the New York session, we see that there's volume at 6 a.m. to 7:30 a.m. Now, sometimes it's not always that there will be volume here, right? Sometimes. So what's going to happen is sometimes when you're going to come towards the New York Open, the pre-New York, what you might find is that there's consolidation, right? So when you see consolidation during this time, you know that, okay, even if price is consolidating at this time, these are the times normally we do live streams, right? So normally when price is consolidating at this time, we know that, okay, if we're ranging, the next time of volume is going to be at 8 a.m. Eastern, right? So we wait. We wait for their volume to come in. Normally when price is ranging, we're waiting for a breakout. And when we look at the time, we're like, okay, next time there's going to be a breakout, it's probably going to be at 8 a.m. Eastern, right? If there's no breakout at 8 a.m. Eastern, the next time of volume is going to be at 9:30 a.m. Eastern, right? So you're waiting. At the same time, for the London session, if you're at pre-London from 1 a.m. to 2:30 a.m. Eastern, which is like around 7 a.m., 6 a.m. London time, till 7:30 a.m. London time. If price is ranging during this time, you know that the next time of volume is going to be 3 a.m. to 4:30 a.m. Eastern. So it makes no sense for people to try to trade when there's no volume in the market, when price is ranging. So you have to identify that, okay, these are the times when there's going to be volume in the market. You have to wait for volume to kick in because you can't get in a drawdown if you're not trading based on volume, right? So this is really important. Market sessions, you have Asian session, London session, you have pre-London, London Open, you have New York session, pre-New York, New York Open, New York Stock Exchange, London close. Really, really high volume times here, right? So market sessions, really, really important, right? You have to identify what time is going to suit you best, and based on that time, you'll be able to trade further on. So I'm pretty sure there are no questions at this time. Let's take a look over here. Probably not. All right, perfect. So what we're going to do is, next, we're going to talk about candles, right? Now, for a lot of people, this is going to be a very, very basic stuff over here, but I think at the same time, we can also have some sort of a refresher here too, right? I think we have around 1,400 people in, so it's going to be pretty interesting. Okay, candles. Man, candles are going to change your life here in trading, trust me. Man, my handwriting is not that good. Okay, perfect. So, what's the basic definition of candles, right? First thing you need to identify is that what does a candle mean in the market? Whenever you have a candle forming in the market, this candle represents billions and billions of dollars being moved in the market. So our job as a trader is to identify where a candle is going to move, right? If the candle is going to move up, or is it going to move down? Because if it's going to start to move up, we have the opportunity to have buy positions and make some sort of dollars in that market, right? So when we look at the candle, a candle consists of, let's say we have a body. Let's say this is a bullish candle right over here, right? Next, we have a bearish candle, which kind of looks like this as well, right? So the bearish candle, bullish candles, they look the same. Generic sizes like this. I know candles can be like this big. Someone is saying like, okay, doji candle, morning star, whatever, right? So there are different types, and there are ways to read these candles as well, and that's what we're going to talk about here later on. But first, we need to identify what these candles mean, because I know there are a lot of new people here too, so we're going to talk about this here first. So this is a bullish candle, right? Bullish candle, which means that whenever you have a bullish candle, it means price is moving up, right? When price is moving up, you have to identify that, okay, price is opening at the bottom and price is closing at the top, right? So it's opening at the bottom, closed at the top. These are the wicks. Wicks basically mean that price tried to go down and it made a low over here and it couldn't go beyond that point, right? And then again, price tried to go higher than this point and it made a high over here and it couldn't go beyond that point. So when people ask me, hey man, like, when you're looking at the candle, what's the high and what's the low? This is the low of the candle right over here, and this is the high of the candle right over here, right? These are not the highs. This is the body high, this is the body low. So this is the candle low, and this is the candle high. Now, before we talk about how these candles are formed, no, actually, let me go back in time in 1990s, and let me explain to you how these candles were formed before, right? So in 1990s, I was actually talking to a friend of mine, around like a year ago, and he was talking about how he started trading. Actually, you know what? Let me just move this camera here a little bit. All right, let's move it here a little back here. Yeah. Can you teach us about muscle building instead of Forex? Yeah, man, just gotta eat a lot of protein. The muscle's gonna come in. Okay, so I was talking to a buddy of mine, and we were talking about how he started trading in 1990s. So basically what would happen was that they used to get these tapes of prices, right? They'd get these tapes of prices. And what that means is that what they would do is, let's say that you came to the market at 2 p.m. If you came to the market at 2 p.m., so what you're going to see is, let's say you're going to get a price on USDJPY, and that price is going to be 100.50 at 2 p.m. So what you're going to do is you will have this graph paper, and on that graph paper, what you're going to do is you will mark a line at 100.50. So when you have a mark lined up at 2 p.m., right? So now you're going to monitor price from 2 p.m. all the way to 3 p.m. So you're monitoring price, right? What you're monitoring is that, okay, what are the fluctuations? So if price started at 100.50 at 2 p.m., let's say, for example, from here, price moved down and it came down to 90.50 from 2 p.m. to 3 p.m. And as we reached 3 p.m., price actually was at, let's say, 120.50. And during this time, it made a high at 130.50. So this is how they would create the candle, right? They would see that from 2 p.m. to 3 p.m., what was the lowest price we got? Lowest price we got was 90.50, right? You're like, okay, perfect. So that's maybe the low of the candle. And what was the highest price we got? The highest price we got was 130.50. So what does this mean? This means that within this hour, right, price made a high at 130.50 and price made a low at 90.50. So this is what you had. This is a candle, right? This is how they were drawing candles back in the day, right? So you can just imagine like how long, what kind of a tedious process it would have been to draw candles, right? But now, man, listen, like we have computers, we have charts, candles are printed for us, we don't have to wait anymore. And man, like people back in the day, they were really good traders because they had to wait for candles to form, right? They literally had to wait and draw candles, man. Can you imagine? Can you imagine the gulag doing that here? No, probably not, right? Okay, so back to candles. So this here, you have a bearish candle right over here. Obviously, you know, everyone knows this. A bearish candle, it opens at this point. Obviously, it closes at this point. Bearish candle high is right over here. Bearish candle low is right over here. So since we have bearish and bullish candles formed, we're also going to talk about trends. Actually, let me just move this here closer here, right over here. So now, because right now we're going to talk about how to read candles in trends, right? Because everyone knows about candlesticks, bullish candles, bearish candles. The trick is how to identify when candles are moving up and how to identify when candles are moving down. And this is really, really important. I hope everyone's making notes. Well, this is being recorded anyway, so you can probably go back to this video and take a look at this. Okay, candle trends. We're going to talk about candle trends. So what do you know about trends? The basic definition, actually, before I go into the basic definition, okay, so this is the basic definition of trends. The trend is something like, you've seen it, people draw trends on their Instagram pages and YouTube charts and this and that. Perfect, right? A trend is something like this, that goes up, comes down, goes up, comes down, goes up, right? This is the basic definition of a trend, where price is making a high, then we make a lower high, then we make a higher high, a lower high, higher high, lower high. I know some people are drawing this at the same time, which is pretty good, but it's pretty simple there too, right? So this is a basic definition of a trend. Now, what does this trend means based on candles, right? So before we talk about candles in this trend, let's also talk about time frames, right? So actually, like, you know what? We're going to talk about time frames here in a little bit. So let's talk about candles here first. So whenever you see a trend like this, you have to kind of like map it out, like, okay, what would this look like based on candles? And let me just bring this a little bit closer here to see. Let's see here. All right, perfect. Okay, so whenever you're drawing candles, a candle is going to look like this, right? So let's say we have a support down over here, and you have a candle forming just like this, right? Now, let's say this is a 1 hour time frame. Now, when we talk about time frames, you have to understand that as we go up on the time frames start to get stronger and stronger, right? So let's say you have the 4 hour time frame. 4 hour time frame is going to be stronger than your 1 hour time frame. 1 hour time frame is going to be stronger than your 30-minute time frame. 30-minute time frame is going to be stronger than your 15-minute time frame. Now, what does this mean when we talk about support and resistances, right? So let's say this candle is on the 1 hour support. If this candle is on a 1 hour support, this means that this is the strong support. If this was a 15-minute support, then you could say, hey, like, you know what, this is a 15-minute support, so this is a weak support, right? So let's say for terms of explanation, if this is a 1 hour support and we're thinking that, okay, the trend is bullish and prices should go bullish, in candle terms, what this would mean is that the next candle should have a higher probability to continue up, right? What this also means is, now, let's say if we look at this candle over here, this candle obviously closed that support, right? And if you look at the next candle for it to continue going up, it has to respect the low of the previous candle. Make sense? Like, once this candle is forming, you don't want this candle to break the low of the previous candle. Just like right over here, when we have trend moving up and when it's retracing, you don't want this retracement to break the low of the previous low. Let's say, for example, if we have some sort of a retracement right over here, right? So let's remove this. And what we're going to do is we're going to do a little bit of a retracement on this trend for explanational purposes. So let's say price made a support right over here. It's not straight. So let's say price made a support right over here. Price moved up. Now, when price is retracing, you don't want this retracement to break the low of the previous low. Just like you have the candles right over here. If you think candles are moving bullish, you don't want the candle to break the low of the previous candle. You want it to break the high and then make a new high right over here. Same thing right over here, right? Price came up, made a low, came up, made a high, came down, made a lower high, and now you want this to continue up to make another high. And that's where you have the trend. You know, which is why when we're looking at candles, you're anticipating, if you have a bullish candle forming at support, you're anticipating the next candle to respect the low of the previous candle and continue moving bullish, right? This is a really basic definition of a trend, you know, based on just candles. We've tried this in live streams, we've tried these in simulations, and all this work. Well, I'm not going to say all this work, but they work like around 80% of the time, right? Because there's always a probability. In the same way, when we're looking at, let's say, resistances, right? So this was an example of a bullish trend. And what we're going to do is we're going to take a look at the bearish information right over here now. Let me see what the gulag is up to over here. They're like my little children now. Is this Raja? Yes. All right, perfect. So now let's say we have resistance up over here, right? We have resistance up over here, and actually, let's remove this coloring over here. Let's say we have resistance up over here, and you have candles that are moving bullish at this point on this resistance, right? And you have the next candle that kind of like breaks up but closes right over here. What most people are going to do is they'll try to take a sell over here, right? And the reason they'll take a sell over here is because they think price is going to reject this area, right? What we think price is going to reject it, but what we see is that price is still approaching this area, right? So the problem with taking a sell at resistance is when you take a sell and you're placing a stop loss up over here, you're taking a sell when the candle is bullish. It makes no sense at all. I mean, it makes no sense to take a sell when candles are bullish, right? You have to wait for a candle to turn bearish, right? So when you're taking a sell at this point, we don't know whether the next candle is going to continue to go up and break this high and then come down, or what it's going to do. We don't know that. So we have to wait for candle to close bearish. So let's say for explanational purposes, we have a candle that's actually closing bearish at this point right over here, right? And let's say, for example, that this bearish close is in a downtrend like this. So when you have a downtrend, it does the same things as the bullish trend right away, right? So price is going to make a low, right? It's going to make a lower low. It's going to retrace. It's going to make a lower high. It's going to come down. It's going to make another lower low. It's going to break this low over here. It's going to retrace. Now, when it's retracing, it's not looking to break above this high right over here, right? So it's going to continue down and make another lower low, and this is going to be a it's going to be a lower high right over here, and so on and so forth, right? So when you're looking at the candles and you're anticipating that this is the 1 hour candle close, if this is a 1 hour candle close, this is a strong resistance right over here, which means that if a candle is closing at a 1 hour zone, it has a higher probability to continue in that direction. If this candle is closing in a 15-minute rejection zone, then what happens to the probability? Tell me, guys, what happens to the probability? When candles are closing at a 15-minute zone, that's right, the probability becomes weaker, right? So when you have a candle closing below the zone on 15-minute, there's a less probability that the next candle is going to go down. Why? Because 15-minute are weak confirmation time frames, right? If this is on the 30-minute time frame, it's still pretty strong. 1 hour time frame, really good. 4 hour time frame, amazing, right? So let's say you have a candle forming over here and you're anticipating price to go bearish. Now, when we're looking at this trend right over here, we're anticipating the next candle to maybe retrace but respect the previous high and then continue down to break this low and then continue down and make a bearish candle, right? Some people would say, okay, you know what, this is an impulse entry and this and that, so that's what we're going to talk about next year or probably, when we have time. But right now we're just going to discuss some simple concepts, right? So you have a candle forming bearish and you're like, okay, like, you know what, for a candle to go bearish, it needs to respect the previous high if it's going to make a lower high and a lower low at this point, right? This is the basic definition of trends. That whenever you have volume, okay, yeah, so these opportunities are going to happen only when you have volume in the market, right? So when you talk about volume in the market, you have to go back to your notes to see that, okay, what times is going to be volume in the market? Because whenever there's going to be volume in the market, you're going to get big candle formations, right? Let's say this is the 8 a.m. Eastern, New York Open. So this is the point where you're going to probably get a bigger candle forming, right? Whenever you see bigger candles form in the charts, those candles are the candles you should be taking trades on because those are volume candles. And whenever there's volume in the market, you have higher probability to make some money in the market, right? Because that's what we're here for, to make money in the markets. So you need high volume candles to make money in the market over here. So these were basically trends, right? I'm sure this is clean, simple. Whenever you see like, a 1 hour candle closing at a support, understand this, that you need candles to basically like close in your direction for them to have a probability to continue moving up, right? So next, what we're going to talk about are candles with no top wicks and no bottom wicks, right? And candles with wicks and stuff like that. That's what we're going to talk about right now. Before we do that, I have to kind of like stretch my arm because my arm is getting tired a little bit. Marker is pretty heavy. This is heavy knowledge over here I'm holding. I'm holding heavy knowledge. Okay, so let's say that we have a bullish candle and it's closing like this and it has no bottom wick, right? So what does a bullish candle mean? A bullish candle means the price is moving up. When you have a candle closing with no wick at the bottom, this basically means that there's no range for the next candle to go down, right? When there's no range for next candle to go down, this means that when this bullish candle was formed, it couldn't even make a tiny bit of a bearish wick to go down. So what does this mean based on volume? Where is volume mostly pushing price here in this scenario right over here? Up, right? Perfect. Gulag is smart, right? Up. So when you have bullish candle closing with a wick at the bottom, there's a higher probability that the next candle is going to continue moving bullish, right? As long as the candle's low respects the low of the previous candle. These are your conditions for buying trades, right? So all the candle formations that we're going to talk about here are going to be based on the 1 hour time frame, because 1 hour time frame is a strong confirmation time frame and it makes sense to trade on the 1 hour time frame, 30-minute time frame, but as you go lower time frames on the 15-minute or the 5-minute, that's when your probability, it starts to get smaller and smaller, right? So perfect. You want this candle to respect the low of the previous candle for it to continue moving up. But what if you have a bullish candle that's closing with no wick on the top? When you have a candle closing with no wick on the top, this basically means that there's no range for the next candle to go. Whenever you have wicks on the candles, wicks are basically breadcrumbs left by the candle for the next candle to continue in, right? When you have no wick at the top, this means there's no range. Like price came up and it just stopped. It didn't even make a wick at the top. So when there's no range, what I've seen from my perspective and my experience is that whenever you have a bullish candle closing with no wick, there's a 50-50 chance that the next candle will either go up or it's going to go down, right? Which means now, even if you look back in the charts, in the history, what you're going to find is that when you have candles closing with a wick on the top, it's mostly like, the next candle kind of like forms like this. Next candle is a bearish candle. It doesn't go up and you're just confused, right? Oh man, but I thought the candle closed bullish. It should have gone up. Why is it coming down? Because, hey, listen, man, there's no wick at the top of this candle, which is why it's coming down, because there's no range, right? So when you have this bearish candle forming like this, now price is consolidating. So we're going to talk about consolidation here in a little bit too, right? So this is bullish candles with no wick on the top, right? There's no range. At the same time, let's say you have a bearish candle and a bearish candle closes like this with the wick at the bottom and no wick on the top. What does this mean? Does the bearish candle have any bullish volume? Absolutely not. There was only bearish volume in the bearish candle, and bearish candles mean price is moving down. So when this candle is leaving a wick over here, this means that the next candle has the opportunity to fill this wick, probably form something like this, fill the wick, break the low and form your bearish candle right over here. But again, it has a condition to fulfill, right? If you want this 1 hour candle to continue down, the only condition it has to fulfill is that it has to respect the high of the previous candle. And this is where your stop losses go, right? Your stop losses go above the previous candles. Your stop losses don't go above let's say a random 40 pip stop or a random 30 pip stop. It goes above the candles right over here. Because if you're trading this on a 1 hour time frame, you're placing your stops above the bearish candles for sells, or you're placing your stops below the bullish candles for buys, right? That's your condition for a trade. Because let's say if this candle, right? Let's say if this candle starts to come down, right? It starts to come down and starts to break the low of the bullish candle, your stop loss is going to take you up, right? Your stop loss is going to say, hey man, listen, this is not the trade for you to be in, because now there's a high probability for price to continue down. And if there's a high probability for price to continue down, you should be out of this trade, because it makes no sense to stay in the trade when price is coming down, right? So that's where your conditions are placed. That's where your stop losses are placed. Like, some people, what they do is their price will come down to their stop loss. What they'll do they'll make a rookie mistake, man. They'll make these dumbass mistakes, and what they're going to do is they will remove their stop loss, and they'll just extend the stop loss by 20 more pips, right? Now, if you're extending a stop loss by 20 more pips, and you have a bearish candle closing like this, where do you think price is going to go now? You think price is going to go up or it's going to go down? When you have a 1 hour candle closing bearish below this candle, it's going to go down. Obviously it's going to go down. Now there's a high probability for the next candle to go down and now take out your bigger stop loss at 20, 30 pips, wherever you placed it. So it's really important to have stops below the bullish candles. I'm going to say it again. It's important to have stops below the bullish candles on the 1 hour time frame, safe stop losses. It's better to have stops above the bearish candles for sells in 1 hour time frames, right? You're going to be much safer in this respect, which is very important. Perfect. So we went over market sessions, we went over trends, we went over some candles with no wicks at the bottom, wicks at the top. I think now is the time to talk about consolidation, because a lot of people get stuck in consolidation. Let me see what's the time over here. Okay, not too bad. 37 minutes. Pretty good, pretty good. Okay, so consolidation right over here. How do you identify consolidation, right? So we're going to talk about that. How do we actually identify consolidation? Because a lot of times, like people ask me these questions, hey man, so I was trading and I was stuck in consolidation and I don't know what was going on. So we're going to talk about how to identify consolidation, right? So let's say we have a support, right? We have a support right over here. And we have a candle that's closing bullish at support. Whenever you have a candle closing bullish at support, we know that, okay, there's a high probability for the next candle to continue moving up. If there's a high probability for the next candle to continue moving up, probably that next candle may look. So let's say someone takes a buy at this point, right? So you're taking a buy at this point and you're anticipating the next candle to move up, next candle moves up, breaks this high over here and goes up, and you're like, okay, perfect. Like, you know what? Price is moving up at this point. Now, when price is moving up, let's say you're still in the buy position here and you're saying, okay, like, price is going to continue moving up and we're going to have a great day. So what you do is you move your stop loss from the bottom to right over here, because now you want to trail your stop loss, right? Because if this is the 1 hour time frame, you want the next candle to respect this low and continue moving bullish. But what happens is that the next candle basically forms bearish right over here. So when you have a bearish candle forming like this, right, what you have is one candle forming bearish and next candle forming bullish. So these are two candles forming side by side. So whenever you have two candles forming side by side, there's a probability that price may start ranging, right? Ranging happens like this. So let's say you have these two ranges here. You have a resistance, you have support. So this is ranging, also known as consolidation, where price just starts bouncing in a small range, right? So whenever you have a candle forming bearish like this, not only you have a resistance formed now, but also you have some sort of a rejection formed right over here, right? Now you have candles closing side by side. So these are basically ranging at this point. So then what's going to happen is that you might see a bullish candle form like this, but respecting this resistance, and now we're basically ranging, right? There's no buys at this point, right? Because price is ranging. The only buys you might see is that if the next candle starts breaking the high over here, and then you can say, okay, next candle can start to continue moving up. But if the next candle is not breaking the high, man, price is not going anywhere, because that's basically resistance right over this. So you can have a candle form like this, and next one can basically come down over here, and now we're basically ranging at this point, right? So the best way to identify a range is whenever you have two candles printing side by side. When you have two candles printing side by side, then you have probability that price may start ranging. And also at the same time, really important, you have to check out your time too, right? You have to check out the time. So let me just draw a clock over here. So this clock, we're going to identify that this is the time, right? You have to check your time, that is this the time when there should be volume in the market, right? It's very important. Let's say that this move up. Let me get a better marker over here. Okay, so let's say this move up was at 6:30 a.m. Eastern, which was pre-New York, right? You had volume, price moved up, yada, 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 perfect. And then price started to range over here, right? If price started to range over here, and if you look at the time and you saw that the time was 8 a.m., which is New York open, and price is ranging, you know that, okay, if price is ranging at 8 a.m., probably there's going to be volume at NYSE open, the New York Stock Exchange open, right? So now you have to wait for price to either break above these highs, or you have to wait till NYSE to see that if a candle can break up or if a candle can break down, right? That's very important. So you have to wait for times when there's going to be volume in the market. Actually, like, you know what, in the chat, can people write W if this is really, like, you know, if this is going as planned here? Let's write W over here. Awesome. Perfect. Oh, beautiful. We got 3 W's, 4, 5, 6, W. Awesome. Perfect. Right? So you have to identify when there's going to be range in the market. When candles are printing side by side, that's a very, very high probability that price is going to start ranging at that point. So we got this. Let me see what else was here on the agenda here. Okay, beautiful. So we talked about market sessions, we talked about candle trends, we talked about candles with no wicks at the top and wicks at the bottom. Next, what we're going to talk about is something really important, right? This something that we're going to talk about is going to be on wick fills. Really, really important concept, really important subject here too. So we're going to talk about wick fills right now. What is a wick fill? When I started trading, we were basically basically, okay, so I'm going to give this a little story what happened when I started trading. So when I started trading, we were trading based on the 4-hour time frames, right? We were trading on the 4-hour time frames. We were looking at 4 pairs. Actually, we were looking at 5 pairs. Oh, actually, you know what? Let's just not talk about this right now. And let me talk about something really, really important here first. And that's something that we're going to talk about here is now, obviously, we talked about market sessions. So I'm going to mark that as market sessions. We talked about market sessions. We talked about the Asian session. We're going to denote this with A, right? We talked about the Asian session. We talked about the London session. And we talked about the New York session. Right? So these are the 3 sessions you have. So now what we have to identify, so we also identified what time there's going to be volume in Asian session. We talked about what time there's going to be volume in London session. We talked about what time there's going to be volume in the New York session. Now what we've got to talk about is that what currency pairs are going to be active in these sessions. This is really, really important. Most people don't know which currency pairs to trade. You know, because we have people talking about, you know, pairs that are closed in New York session, in London or Asian. So that's what we're going to talk about. So I want to know, with your help, what currencies are open in the Asian session? We got answers coming in. JPY. Okay, perfect. We have JPY is open in Asian. We have AUD open in Asian. We have NZD open in Asian. Chinese, Korean currencies. Okay, perfect, right? These are the currencies that are open in this session, right? This means that at Asian time, you have the Japanese banks open, you have Australian banks open, you have New Zealand banks open. So these are the main banks that are open in the Asian session. So we're only going to concentrate on these currencies right over here. Now let's talk about the London session, right? What's the first thing that comes to your mind when you think about the London session? Perfect. We got the pound, GBP is open at this time. We have Euro open at this time. We have CHF open at this time. We have Russian ruble. Okay, we have Russian ruble open at this time too, right? But like majority of the time, we have pound, euro, and Swiss franc open at this time, right? These are the only currencies, major currencies, that are operating at this time. Next, we have the New York session, right? New York session is the most volatile session of the market, right? So when we talk about the New York session, we talk about, we have CAD open at this time. We have USD open at this time. We have XAU, gold, moving at this time. Now, gold can also move in the Asian session too, right? Because you have fluctuations in the yen. Gold can also move in the London session because there's volume in the London market. Gold is like universal a little bit, right? So in New York, we have CAD open, USD open, we have GBP open at this time, we have Euro also open in the New York, and like Swiss franc and all that fun stuff. So these are the currencies open in New York session, London session, Asian session. Now, your next step, if you're going to trade the Asian session, you have to identify what currency are you going to trade in the Asian session. Are you only going to trade the yen? Are you only going to trade Australian dollar? Or are you only going to trade New Zealand CAD? Right? So the best way to identify is that, okay, now another thing you have to identify, you know what I'm going to do? I'm going to get a bigger board because now I realize I need more space. So whoever said about getting a bigger board, I think you were right. But we all learn like that, right? Okay, anyway. So now what we got to talk about is that, okay, which currency is going to be best to trade in the Asian session, right? So first of all, you need to identify is that you only need to trade a pair that is influenced by one currency, right? If we look at JPY, and if we say that, okay, in the Asian session, Euro JPY, right? If you look at your JPY in the Asian session, we can see that in the Asian session, your JPY is only influenced by the yen, right? So whenever there's a change in the yen, that's going to move your JPY. Same thing goes with USD JPY. Same thing goes with GBP JPY. Right? This is the reason when you look at these JPY pairs in the Asian session, you're going to realize that most of the time, these three pairs are going to move in the same direction. And the reason why is because these three pairs are being influenced by yen right over here. Right? But if we look at, let's say, pairs like, let's say we look at AUD JPY. Now, the problem is that AUD JPY is influenced by not only the yen, but it's also being influenced by the Australian dollar, right? So now you have two currencies affecting one currency pair. So it's going to be really hard to identify where price is going to move, because if you really want AUD JPY to move in a certain direction, you want one currency to be really, really strong, and you want one currency to be really, really weak. And that's the only reason this pair is going to move. But if you have only a pair that is influenced by, let's say, one currency, let's say you have GBP, JPY, then you only need the yen to move, right? Because if you can only get the yen to move, that's going to move the overall pair, right? Same thing when we talk about London session here. In London session, what you're going to notice is that the pound, let's see here, right? What you're going to notice is that GBP, JPY, and GBP, USD, they will normally move in the same direction in the London session. And the reason why is that in this pair, yen is closed. In this pair, USD is closed. So the only currency moving this pair is the pound, right? And it makes much more sense to trade pound yen and pound USD in a session, which is only influenced by one currency pair, right? Consider it like this, right? Let's say you're talking to somebody and you need to make plans with a person to go out or whatever you want to do, right? And now you have another friend and you're telling him to go out, and he's like, oh, you know what? Let me talk to my wife, and then let me talk to my mom, and let me talk to my dad. So now he has these three variables. He needs to get them on his side for him to go out with you, right? But when you have a person who's just independent, he's like, oh, you want to go out? All right, let's go. Let's hit the bars, right? So that's what's happening right over here. You have one currency influencing the whole pair. If we talk about, let's say, Euro GBP, right? If we write Euro GBP, now there's a problem, right? And the problem is that now you have this currency pair and it's being influenced by the euro and the pound. So if you want this to move, you either want the euro to be strong and pound to be really weak, or vice versa. So when you're looking at a currency pair that is influenced by two currencies, it's going to get a little difficult for them to trade. Because let's say if both currencies are bullish, right? Let's say euro is up and pound is up. What do you think is going to happen to price action? Will there be a trend? Will there be a trend? No, exactly. There's going to be no trend at that time because both pairs are strong. If both pairs are strong, it's basically like a tug of war where no one knows where to go, right? At the same time, when we look at the New York session, this is when things get a little tricky, right? In the New York session, personally, I like to focus on GBP JPY. And the reason why is because pound is volatile as it is, and the yen is closed at that time. So I know that for my pair to move, I only need pound to either be strong or I need pound to be weak. And then I'm going to know that, okay, this pair can move. But if I'm looking at, let's say, GBP USD, in this scenario, man, I want pound to be strong or dollar to be weak, or I want pound to be weak and dollar to be strong. So now I have to look at more variables, right? So now there's more thinking involved at this point. So which is why sometimes in the New York session, what you might find is that the pound yen and pound dollar, they may not move the same way because they're being affected by these scenarios. The only reason pound yen and pound dollar are going to move the same way in the New York session is if the pound is really strong and the US dollar is not moving at all, right? So whenever you're looking at session, first of all, you have to identify what time in the session is going to suit you best, right? The second thing you need to identify is that what pair are you going to choose in these sessions? This is really, really important, right? If you're choosing, let's say USD CAD, same thing. You want one pair to be really, really strong or one pair to be really, really weak. If you're trading USD JPY, let's say you're looking at USD JPY, in this instance, it's still pretty good, but USD JPY has lower volume, it still moves. So in this way as well, you will need just one currency to be either strong or to be either weak. Right? So when you look at things in this perspective, you have higher chances of winning. You have higher chances to grab volume in the market, to participate in the market, because now you're only expecting one currency to move rather than two currencies to move. This is why also the reason is that I hate Euro USD because one thing is I've never won a trade on Euro USD, and second thing is when I look at Euro USD in the New York session, you know that it's being influenced by the euro and it's also being influenced by the US dollar, so it becomes a mess here to trade Euro USD at this point. How's the gulag going? Pretty good. All right, perfect. We're almost like an hour in. So we talked about market sessions, we talked about currency pairs, we talked about bullish candles, bearish candles. Next, we're going to talk about my favorite setup to trade, right? This is a really, really good setup. And we're going to talk about, and we're going to try to go in detail of this setup so that we all can leave here and learn something from it and probably practice it in the coming weeks here. Yeah, it's going to take a little time to rub this off. You know what I'm going to do? I'm going to wait for Boxing Day and then I'm going to get one of those electrical boards. Yeah, I saw them, they're pretty sick. Probably just going to be a write-off too for my business. Okay, perfect. So now we're going to talk about my favorite setup. Actually, let me see how much battery I have left over here. We have, I got 82% left. Hey Raja, if we do technical analysis and there's no upcoming news events, also then, your question by the way. Okay, so we're going to talk about my favorite analysis over here. And before we do that, I'm just going to take some coffee. Okay, perfect. So the setup that I really love to trade, that I really like to see in the market is basically in a trend, right? If you haven't made notes, this is the note. This is the note you have to make, right? So when you're looking at a chart, the first step towards looking at the setup I love to trade, I've had an 80% winning probability on this setup. I've made most of my money trading this one setup, and we're going to talk about that. So first of all, what you got to do is you have to zoom in onto the chart and then look at the market, right? So my favorite setup is basically, it's a wick fill, right? So we're going to talk about wick fills on the high time frames, and then we're going to go into the small time frames and kind of see how candles are formed in that instance. So let's say that we have a bullish candle like this on the 4-hour time frame. We have a bullish candle like this on the 4-hour time frame, right? So now if this is a 4-hour time frame candle, 4-hour, what will this look like on the 30-minute time frame, right? Or what will this look like on the 1-hour time frame? So it might look something like this. So we might say that we'll have a bullish candle forming like this, and then let's say we'll have a bearish candle forming like this. After this, we might have a bullish candle moving up. We might have another bullish candle moving up. We'll have another one, maybe it's going to move up like this. And then we're going to get a bearish candle, which may form like this. And then it's going to leave a wick over here. And another one may come down, leave a wick at this point. So how many candles we got right now? 1, 2, 3, 4, 5, 6, 7. 7. And then let's say we'll have another one form like this, bearish candle like this. So this is what the 4-hour candle here represents. Right, if you look at the 4-hour candle right over here. So actually, let me just make this edit this a little bit. So if this is the 4-hour candle, so you have to identify that, okay, if this is the 4-hour candle, how many 1-hour candles are there in a 4-hour candle? Someone mentioned 6. I think you need to get some things checked in your brain over there, because if this is a 4-hour candle, 4-hour candle would have 4 1-hour candles, right? So if we have 4 1-hour candles in a 4-hour candle, how many 30-minute candles are going to be in the 4-hour candle? Right? There will be 8 30-minute candles in the 4-hour candle. So if we look at this 4-hour candle, we have to identify where's the low of this candle and where's the high of this candle, right? So this is the low right over here, and this is the high right over here. So notice how this candle went down, made a low, came up, went all the way up, created a high over here, and then retraced and closed right at this point, right? Remember when we talked about the bullish candles, that they open at the bottom right here, they close at the top here? This is the same thing happening right over here, right? So this is where you're reading market structure, right? The reason I'm talking about the 4-hour candle, also let's say that this 4-hour candle is around, I would say, 40 pips, right? 40 pip big, this 4-hour candle. So if you look in the market structure here, we can see that price started from the bottom. We made a low, right? Price went up. It created a high over here. So this is the same high created on the 4-hour time frame, right? So this is the high created right over here on the 30-minute market structure, but the 4-hour time frame high right over there, right? And now we have candles forming at this point. Now, obviously, let's suppose the trend is bullish. We're moving up, we made a high. So now my favorite setup is this wick fill right over here. What I want to see is I want the next 4-hour candle to wick down and come up and fill this wick, right? As price is going to come up to fill this wick, this is going to be my trade right over here. This is where I've made 80% of my profits this year and the year before that and the year before that, right? This is where I've made most of my profits. Now, what will this look like on the 30-minute time frame right here? What this will look like is if you're looking for a buy, right? You can't take a buy at this point because this is a bearish candle, right? You can't take a sell at this point because we got support right down over here, and you need this support to break for price to do a sell, and that would mean that you want this 4-hour candle to go bearish. So we're going to talk about bullish candles right over here. So what I want to see at this point is I want to see maybe now if this is going to be the start of the new 4-hour candle, we might see a candle forming maybe like this, right? When this wick was formed down at the bottom, this bottom wick is a low formed on the 4-hour time frame, right? And then what we might see is that if the next candle starts to form bullish right over here, this is my confirmation to enter the trade, right? If this is a 30-minute time frame and the 30-minute candles are forming bullish, we're creating a support, right? So whenever you have candles coming down and you have the candle closing bullish after a bearish candle, boom, support is formed, right? If you have candles moving bullish and then you see a bearish candle form, then that's what? Boom, that's a resistance form, right? With just one candle. That's how you identify these zones. Now, when you look to the left-hand side, you might see a resistance somewhere to the left-hand side right over here. You might see, oh yeah, we have a resistance right here. No, that resistance doesn't matter. This is your new resistance form. And this is what I call the money trade this one right over here, right? So because if I have a bullish candle formed over here, and when we talked about the trends earlier on, what did we talk about, right? We want this candle to respect the low of this candle and continue moving bullish. So what I'm going to do is if I see this opportunity happening, I know that there's an 80% chance that price is going to continue up to retest this high, right? If price is going to retest this high, now you have to identify that, okay, if you want price to continue up, where are you going to place a stop loss? We did a quiz yesterday on my Instagram channel, and some people said that they will maybe place their stop loss below a support. So this is where they'll place their stop loss below the support, right? And I was saying that no, I think we need to place our stops below this bullish candle if we want price to go up. Because guess what? If price starts to come down and you get stopped out over here, now you're out of the trade early, right? But if price breaks this low and continues down to this support over here, now not only we're breaking the lows of the 4 hour, but we're also coming down to a support where now the chances may increase for price to break the support. And man, if your stop loss gets hit below the zone, now you've lost way more than you would have lost if you had a stop loss right over here, right? So whenever you're taking a trending trade, you're placing the stop below the bullish candle right here. So now what I'm anticipating is the next candle to wick down, respect the low of the previous candle, and continue moving up in this clean range. See this clean range, clean candle, clean candle, clean candle. So we're anticipating the next candle to continue up to retest this high. So as the candle is going to come up to retest the high, there's also going to be a wick fill on the 4 hour time frame. Makes sense? So you kind of like absorb this in slowly, right? We made a structural high. This high was the wick created on the 4 hour time frame right over here, right? Structure high. Price retraced, 4 hour candle retraced and closed at this point. This is where the 4 hour candle closed. Now we had this wick to fill. No, now we had this wick to fill and this range to fill on the smaller time frames, right? So wick fills on higher time frames are ranges on small time frames. I'm going to repeat that again. Wick fills on higher time frames are ranges on smaller time frames, right? So I'm sure everyone is making notes of that. Perfect. So this is where I'm taking a buy at this point, anticipating price to continue moving up. And this is the move where I'm making money. This is the move where I'm making some sort of a profits as price is moving up. And this is all what I need. Now, this may take 15 minutes. This may take 5 minutes. Fuck, man, this may take 10 minutes, right? If this is taking 10 minutes and 5 minutes, perfect. I made my money in 15 minutes, 10 minutes. Now, what I can do is as price comes up to a range, I can put my stops at break even and let the rest run. If it continues running based on the 4 hour, awesome. I'm making extra profits, right? But if it continues up, I've secured profits and that's it. I'm done for the day. I've done this over and over and over again for the last 4 years and made amazing returns on this strategy. Simple. And when will this happen? This won't happen all day because the number one problem people have is that they'll start to look for these big candles in the afternoon time. You know, at like 12 p.m., 1 p.m., 2 p.m., man, it makes no sense because there's no volume at that time. These situations will only happen when there's volume in the market. And when there's volume in the market, you have the Asian session, London session, New York session. Those are the times where there's always going to be volume in the market. And it will always work in that sense. Now, also, okay, listen. You know what? Let me take that back. It's not going to work all the time. There's a probability. There's an 80% probability this will continue to work because sometimes, man, listen, sometimes how easy this may seem, sometimes what may happen is that the next candle, let me just remove all this mess over here. What can happen is that the next candle can go up and then it can come down and break the low, right? What happens at this point? When your stop loss gets hit. If your stop loss gets hit, that's totally fine. Because, hey, like, you know what, maybe at this point, the probability wasn't on your side, you know, and you can't take that personally. I've taken losses like this, but the main thing is, like, if this was a 20 pip range, and if this stop loss was around, let's say, 13 pips, that's still perfectly fine. Because if price is coming down to stop me out, I'm going to look at this and say, okay, you know what? That's fine. It works most of the time. So if I take a loss like this, I'm not going to chase this trade. I'm going to say, okay, you know what? Perfect. I took a loss. Awesome. Time to call it a day. What most people are going to do is they'll take this loss and then they'll take a sell over here. They'll take a sell over here. Price will go down a little bit and then boom, it's going to go back up. And now they're lost in the buy and they're lost in the sell. Why? Because it changed your bias. Bias we can talk about later on, but like this is the setup that has always, most of the times, made me money. Extremely easy setup, happens all the time when there's volume in the market. And this is how you break down a wick fill. Same thing goes when you look for bearish candles, for bearish wicks to fill. Same idea over here, right? But also understand that it will only happen when there's volume in the market. And yeah, that's the reason why. Hope this makes sense. I'm running a little bit out of time over here. And before I run out of time, I'm going to touch base on how we used to trade when I first started. Why was it profitable? And why I started taking losses in that scenario. So we're going to talk about that right now. Let's take a look over here. Okay. So when I first started in May 2016, what we would do is we would look at 5 pairs, right? They were mostly like your generic USD. Actually, you know what? Instead of writing USD JPY and all those things, I'm going to write UJ, USD JPY. We used to look at USD CAD. We used to look at AUD. Well, I used to look at AUD, USD. There was some gold involved. And there was another pair, I forget. I think it was, I forget. Let's say that was New Zealand CAD. So we would look at 5 pairs. And my strategy was that, okay, now you know what? So what I learned from baby pips was that you have resistance and you have support, right? This is what I learned from baby pips in the start. So you have support and resistance. And what I learned was that when you're looking on the 4-hour time frame, and if a 4-hour candle is going to close at a support, there's a higher probability that we will bounce from a support because, 4-hour support is much stronger than like a 1 hour or 30-minute support. Same thing goes for resistance. That if you have a 4-hour candle closing at resistance, there's a high probability that we will reject from here. That was a strategy. Now, when I looked at the time, I'm like, okay, perfect. Like, you know what? When do 4-hour candles close? So in Eastern Standard Time, 4-hour candles close every 4 hours around 1 p.m. You have 5 p.m., you have 9 p.m., and then you have 1 a.m., 5 a.m., 9 a.m., and so on and so forth, right? So these are the times when 4-hour candles are basically closing. So we would look at 5 pairs and we would see, okay, let's see where the 4-hour candles are closing. So whenever a 4-hour candle would close at a support, right? Let's say you have a candle closing at support, I would just take a buy. Candle closing at support, boom, perfect. I'm going to take a buy. And my stop loss would be around 15 pips, and rest is up to the Forex gods. And most of the time what would happen was that we'll get a little bit of a retracement, right? Because we're at support and the 30-minute or the 1-hour time frame to start to retrace, price would go in 10 pip profits and 15 pip profits. And I'll say, okay, you know what? I'm in 10 pip profits. Perfect. I'll take those profits. I'll put stops at break even and I'll let the rest run. And what would happen was that price would come back down, stop me out, and that was about it. So I started making really, really good progress based on this. So every 4 hours, I would look at these 5 pairs and I would see that which 4-hour candles are closing at support or resistance, and just take a sell if we were at resistance, take a buy if we were at support, get 10, 12 pips, call it a day, perfect. But the problem started, this is where the problem started, right? Problem started when price would be at the support, and sometimes, price would just continue moving down and stop me out. Sometimes that would happen. Now, when I allowed price to stop me out, I was still making profits because most of the times I was winning. The problem happened that when I started to be a smart ass. What that means is that I decided to remove as price would start come down, I would remove my stops. So when you remove your stops, man, now you're in for a roller coaster ride, because now when you're going in a drawdown, you're just like, holy, okay, we're going to drawdown right now. So if we're going to drawdown right now, it has to come back up. You start thinking, you start hoping, and that's when things just go south, you know. And then I started losing these trades, starting getting bigger losses and smaller wins, because my wins were like, 10, 15 pips, but my losses were like 30, 40 pips because I removed my stop loss, and then I started learning about some other concepts and advanced concepts. And yeah, it was a big mess at that time. So I really had to look back and see that, okay, how I could avoid these mistakes, what I did wrong. And I realized that the only thing I did wrong was removing my stop losses. Because the stop losses are basically conditions for your trade to work out. If you don't put your stop losses, your trades are probably not going to work out, right? So, perfect. This is all that we had to talk about. We're starting a new project. It's called Dominion Markets. It's going to be launching January 2021. It's a crypto broker. You can search it on Instagram. You can go to the page. You can go to the website. You can read all the information we have on Dominion Markets. And yeah, man, thank you so much for everyone who tuned in this morning. I really appreciate it. I hope we all learned something from it. And this is going to be uploaded on YouTube too, so you can watch it. You can share it with your friends. We discussed some really basic concepts. We started to go over market sessions, how to identify zones, how to identify candles with no wicks, with wicks, wick fills. We also discussed the most important strategy I trade that has made me profits over time. And last but not least, we also talked about what times to trade, which is really important. So again, thank you and see you. Oh, by the way, the live streams are going to continue on from the 10th of January. No, 11th of January. Perfect. Adios. Just got to make sure. There we go.